Hi everyone, after finishing off the introduction to insurance, we are going to do principles of insurance. What are principles? In general, principles are guidelines to decision making and thinking. So when you are guided by something, or when your decision making becomes easier to take, or when you are given guidelines through some thinking process, these are known as principles. Insurance also has 7 principles which we are going to talk about today. Why? Because otherwise uncertainties, eventualities are there, and these uncertainties are to be compensated for. So how are they going to be compensated with different types of insurance? What are the basic principles? The basic principle is one, that sharing of risk takes place, but there are some guidelines which eventually help us in knowing that yes, how insurance helps us. So starting with the first one is utmost good faith. Now what do we mean by utmost good faith? In one line, utmost good faith means that both insured and insurer should trust each other and must disclose all material facts. Otherwise, the insurance company, which is actually getting you an insurance policy, can immediately take that insurance contract back. That means what? Like for example, there are two people. A is the person who wants to get himself insured, and B is a person who is actually going to take up the insurance, the company. Now, what A does is, he is already suffering with some particular kind of ailment, and he doesn't disclose the fact to the insurance company. Medical fitness test happens, and they come to know. So they can stop the contract there and then. You need to disclose all material facts. Sometimes material fact may not be disclosed about a particular house. I get insured a particular house, and then I say that this is on my name, but it is not on my name, it's on somebody else, or it is mortgaged, or there's something like that, or because of which the insurance cannot happen, or it is not exactly mortgaged, it is pledged somewhere else, and I am unable to return the money to the bank, and bank may any time sell it off. So these are the things. Disclosing all material fact is very, very essential for all the people who are taking up insurance policy. Wherein, when you talk about insurance company is supposed to disclose all the clauses. It is we who do not read all the clauses, because they are written so minutely and there are many of them. So we don't read the causes, and then what happens is that at the time any kind of, there's a contradiction in any kind of clause, we are not at a good place. That happens because of our negligence, not because of insurance companies. In case they have not disclosed anything, we can immediately take action against them too. Utmost good faith. So starting with utmost good faith, a contract of insurance is a contract of ubere fide, that is a contract found on utmost good faith. Now, both the insurer and the insured should display good faith towards each other in regard to the contract. It is a duty of the insured to voluntarily make full, accurate disclosure of all facts. Failure to make disclosure of material facts by the insured makes the contract of insurance voidable at the discretion. Discretion means at the power of, or at the say of the insurer. The insurance company can immediately declare that particular contract as an invalid one. Invalid means not okay. So that's about utmost good faith. Next principle of insurance is insurable interest. Now what do we mean by insurable interest? See, the party who takes the insurance, the person who takes the insurance, he must have some kind of pecuniary interest. What is a pecuniary interest? That is the monetary interest in the property, asset, or whatever kind of insurance he is taking, that in case an unforeseen circumstances or uncertainty happens, he may suffer a monetary loss. Now, this insurable interest talks about the insured must have an insurable interest in the subject matter of the insurance when he is taking the policy. Right? Insurable interest means some pecuniary interest. Now, pecuniary here means nothing else but monetary interest. Here it means monetary interest in the subject matter of the insurance contract. For sure, the insured must have an interest in the preservation of the thing or life insured. So he must have that kind of monetary interest in preservation of thing, whatever he is getting insured, so that when financially suffering takes place. Now this is here again financially, money takes place on happening of the event against which he is insured, he is compensated for same. It is not the house or the ship, machinery, but the potential liability of life that is insured, but the pecuniary interest in them. So it's the monetary interest in them for which we take the insurance. Like house, we get it insured because we know the moment there is an uncertainty or event which happens, or a misfortunate event happens, so what is going to happen is we are going to suffer in terms of finances. It is not necessary that one should be the owner of the property. Yeah, it is there. Why? Because, like for example, it is an example out here, a trustee holding property on behalf of others has an insurable interest in that property, because in case something happens, there would be a financial loss which will be taking place. Like for example, if there are two people, A and B, now B owes money to A. A can immediately get B insured, because if something happens to B, his money would not be, he would not get the money back, or his money would be lost. So in that case, what he does is he has the insurable interest in getting B insured. Why? Because financially suffering would be there, right? Next we come to the other principle, that is subrogation. Like I said, now we're going to start with subrogation. What exactly do we mean by subrogation? It means that in case of any kind of loss, if a person who has taken insurance gets compensated by the insurance company and there are some leftovers, the leftovers go to the insurance company, the person cannot make profit by selling those leftovers. Once he's taken his claim, he cannot get or make any profit out of the leftovers. Now, it means what? It refers to the right of the insurer to stand in place of insured after settlement of a claim, as far as right of insured in respect to recovery from alternative sources involved. After the insured is compensated, once he's been compensated for any kind of loss or injury or damage, for the loss or damage to property insured by him, the right of ownership of such property passes on to the insurer. Insurer means the insurance company. This is because the insured should not be allowed to make any profit by selling the damaged property. So you cannot sell the damaged property, you cannot make any profit out of it. Also, same goes for the lost property. Suppose you get some necklace or a piece of jewelry insured. That piece of jewelry is lost, or maybe there is a theft and you lose that jewelry. The insurance company compensates you for the same. But ultimately, since you had lodged the FIR and everything, all detailing was done, you find the piece of jewelry, you have to inform the cops, or it was a theft, so the cops were able to catch hold of the thief. In that case, that piece of jewelry will go to the insurance company. You cannot take it and make profit out of it. Similarly, the house catches a fire, somebody's house catches fire and everything is burnt down, the insurance company gives you compensation, you claim compensation, but there are some wooden, or maybe not wooden, which you shouldn't say, there are some iron made railings or grills which are saved. That will go on to nobody else but the insurance company. You cannot make profit out of the same. So either lost property or damaged property. Even if a car is lost and later on you find it, the car will go to the insurance company. You cannot make profit out of the deal. Subrogation. Next we come to is proximate cost. Proximate cost means exact cost, nearest cost, the most viable cost. Suppose you get your goods insured or you get the ship insured against sinking of the ship. There is insurance for sinking of the ship and loss to the goods, of course, yes. Now what happens? The water seeps into the ship and it sinks because there were some rats in the ship and they made a hole. Sinking of the ship was the nearest cost. Will you be compensated or not compensated? Yes, you will be compensated. Why? Because how water seeped in was not the criteria, but sinking of the ship was the criteria. So proximate cost and insurance policy is designed to provide compensation only for such losses as are caused by the perils which are stated in the policy. So those perils, those risks which are stated in the policy are what we try to compensate you for. When the loss is result of two or more causes, the most proximate, exact, nearest, direct, most dominant and most effective cause of which the loss is the natural consequence is to be taken into consideration. In case of loss arising out of any mishap, that most proximate cause of the mishap should be taken into consideration. Exact, nearest, direct cause, viable cause should be taken into consideration. Next we do indemnity, mitigation. So we are just going to come to the and contribution, next three principles. Next we are talking about is indemnity. Now what does indemnity mean? See, all the insurance which you take for fire, marine or any kind of insurance are contract of indemnity. But when we talk about the life insurance, it is not a contract of indemnity. Why? Because indemnity says that in case of happening of the event, insurance company will compensate you and make you reach to the place where you were before happening of the loss or event. Now, fire, marine or any other kind of property which gets affected by any kind of event, you can get compensation and you can rebuild it or reconstruct it. But someone dies, you cannot get him back because of this principle of indemnity. You can't make him alive. So indemnity does not hold good with life insurance. The life insurance is exception to principle of indemnity. Otherwise, indemnity applies to all other kind of insurance contracts. All insurance contracts of fire and marine insurance are contract of indemnity. Life insurance contract is exception to this principle. Here the insurer undertakes to put the insured in the event of loss in the same position that he occupied immediately before happening of the event. Of course, insured against. In other words, the insurer undertakes to compensate the insured for the cause to him due to damage or destruction of property insured. Same thing, that we are going to compensate you for the same thing and make you reach to the same place where you were before happening of the event. The compensation payable and loss suffered are to be measured in terms of money purely. And also, see, if you take a life insurance premium and X takes life insurance premium and he is life insurance rather, and he is paying a premium of let's say every year 10,000. And the total compensation or total thing which is going to get after accumulation of 20 or 30 years is somewhere around 10 lakh. There is another person who is paying a premium of 50,000 and he may get somewhere around 50 lakh. We are just assuming things, right? So the life of person X and life of person Y, so person Y is more expensive, his life is more valuable for his family members than the person whose life is insured for just a few lakhs of rupees, right? A lesser amount. So it's not so. That is why life insurance is an exception to this principle, right? Indemnify. We cannot indemnify anybody or we cannot indemnify anybody's life. Next we come to is mitigation. Now you take an insurance policy and you suppose you get your house insured against fire and your house catches fire. You will stand like that and just say, let it go. Why? Because I've got an insurance policy, I'll get a claim. It's not so. You must take necessary steps to stop that event from happening or that loss from happening. If you don't do it and if you don't show prudence, the insurance company also doesn't give you claim. The principle of mitigation says that it is the duty of the insured to take reasonable steps to minimize the loss or damage. Means what? The insured must behave with great prudence, honesty and not be careless just because there is an insurance cover. If reasonable care is not taken like any prudent person, then the claim from insurance company may be lost. Insurance company will not compensate you because you did not take any steps to minimize the loss. The last principle which is to be done with principle of insurance is principle of contribution. It is also called double insurance. There are some insecure people, they will take insurance from two insurance companies for the same property. Now in that case, what would be actual claim in case that event occurs or that loss or damage happens or that uncertainty takes place, what is to be done? What is exactly the criteria? How are we going to compensate the people? Now, in such case, what we do is either we give the money proportionately, or in case if you have taken two insurance, double insurance from different insurance companies, one company will pay, the other will not pay. The rest of the settlement they will do themselves. Now, contribution means what? It is the right of an insurer, that is in the insurance company, who has paid claim under an insurance to claim upon other liable insurers to contribute for the loss of payment. So, if you have taken insurance policy from two companies, the two companies will actually divide the losses or take it proportionately or pay you proportionately. It implies that in case of double insurance, the insurers are to share the losses in proportion to the amount assured by each of them. If full amount is recovered from one insurer, the right to obtain further payment from the other insurer will cease. Suppose I take insurance for my house. This is my house. I take insurance from company A for 10 lakh and from company B for 5 lakh. Now, I have a loss of 3 lakh of rupees. Who will compensate for it? Now, what will happen is, proportion is what? 10:5 means 2:1. Now, in proportion of 2:1, it will become 2 by 3 into 3 lakh. That means what? One company will pay how much? 2 lakh, and the other will pay 1 by 3 into 3 lakh. 1 lakh, the other company will pay 1 lakh as compensation. So, that is going to be the right proportion of paying the compensation to the person. So, that is what the principle of contribution talks about. That is all for today. Next, we are going to take up the different types of insurance, the elements and differences.